Number two in our series on common missteps that investors may make is the idea of trying to time the markets. I think a lot of us have had an experience or have read or maybe inherently already know that timing the markets is very difficult, if not impossible. But it doesn't mean that it doesn't look appealing to any of us, including myself, at any given time. But the market and the markets and the economy are very complex. It's going to be very difficult to outguess a very complex system such as the market and the economies. Just in the US, not alone the whole world, global economy. Also, some of the best days in the market returns come on the heels of some of the worst downturns that we've ever had. So, for instance, there's many times in the recession downturn in 2008 or in 2020 in the COVID downturn that we had. There are many of those that there are examples that days after those we had some of the biggest returns in the market. And I don't think too many of us would have thought that would happen, nor let alone had the courage to invest at the depth of what seemed like despair. So over the last 20 years, if you look at some of the major indexes or major market areas that you could be invested in, over the last 20 years, things like real estate have a 20-year annualized return of over 11%. S&P 500, largest 500 companies in America, an average return of over 9% a year over the last 20 years. Maybe small U.S. companies, 9 point something percent over the last 20 years. But the average investor has returned 3.6% average return per year reflected in this chart. And it's not because they might have been invested too much differently than those overall markets in any case or situation. It was the fact that they were trying to time the market, and they probably missed out on some of those best days in the market that followed the worst days in the market because they were not invested in the market at that time. So it's the old adage, it sounds cliche, but it's so true. It's time in the market, not timing the market. In general, if you were in the market in the S&P 500, which not a whole lot of us probably are, we're spread out into different investments, but let's just assume that you were. In the S&P 500, in any 1 year period, the S&P 500 has been positive 73% of the time, but there's been almost a third of the time that it's been negative in any one given year. Over 3 years, it's been positive 83% of the time if you're invested for a 3-year period instead of a 1-year period. In any 5-year period, it's been positive 87% of the time, and over any 10-year period, it's been positive 94% of the time. So obviously, the longer that you're invested, time in the market versus timing the market is to an investor's favor. Throw in a manager with a disciplined approach that focuses on hopefully the volatility of the portfolio and watching the volatility of the portfolio. Maybe the odds of upside improve even more over a S&P 500 portfolio. But needless to say, the longer that you're invested tend to have the better results.